How we doing, everybody? Eddie Austin here with Hampshire Capital. I have, as always, my friend and business partner, Shane Carter, the CEO of Hampshire Capital. We're going to talk about some exciting stuff today on the last deal of the year, bonus depreciation, and why you want to jump in this thing, and how you can save yourself some money. Take it away, Shane.
That's right, Eddie. Thanks so much. As always, a pleasure. So yeah, look, we all of a sudden we looked up and it's November. It's the end of the year, and we've got 2 months left in the year. If you don't have a deal under contract, if you don't have a deal that you're looking at right now, it's not going to close this year. We have the last deal of the year as far as what we're going to be able to do, and I think one of the last deals that's even out there and available to invest in right now. We have until the end of the month, the end of November. The closing is currently set for November 27th, right after Thanksgiving. So folks have time to jump in. We're a little over 50% enrolled in this one already. So just a handful of spots left. And bonus depreciation. So if you have a tax liability, if you made good money this year, you sold a business, you sold an asset, you didn't 1031 it, and you have a capital gains or you have some investment income that you've made this year, and you're going to write Uncle Sam a check, this is your opportunity to invest in this deal, and you're going to get bonus depreciation. We already have a cost seg preliminary analysis from our experts, and we're going to be able to offer about 50 to 60% of the investment return in tax losses this year, K1 losses this year, 2023. So what does that mean? Yeah. That means you invest, if you've got a $100,000 check you're going to have to write to Uncle Sam. Well, if you write us a check for $100,000, you're going to get a $50,000 to $60,000 K1 loss this year. If you want to defray it completely, you invest $200,000, you're going to get 100 to 120,000 in K1 losses this calendar year that you can use to defray those capital gains or positive gains that you've had. So it's very powerful.
Say somebody got not lucky, but somebody put in the hard work this year and they sold a business, so they've got $1 million to invest, say they sold a business, they haven't bought anything else, and their CPA is like, hey, this is your tax liability. Like, you've sold this business, these are your capital gains, and you need to, either pay this much at the end of the year, or you could invest in this deal and you could get 60% of K1 losses on your statement.
Yep, that's exactly right. And this is the last year. So the bonus depreciation is at 80% this year. Next year, it steps down to 60% and 40%. So it's just going to get worse from here on out. So if you're watching this video and you know that you have a capital event and you've taken in some money, but you're not quite sure yet, and because taxes aren't due till April or October of next year, this is your heads up. Get ahead of it now. Have those proactive conversations with your CPA now. Figure it out and get your K1 losses for this year to defray that tax expense.
Yeah. So we should probably talk about the deal real quick. I'll run through the deal metrics so people actually know what they're investing in here. So this is a 206 unit. This thing is in the North Bachman neighborhood of Dallas, Texas. Really nice asset. We bought this thing from a company that had this for 6 or 7 years. Is that right?
Yeah, it's actually more like 8, but yeah.
8 years. Okay. So I know what I got twisted there. So there's actually been tenants on this property that's been there 6 or 7 years. And we can confirm that because the property owner actually owned the property for 8 years. So the tenant demographic, the people that are living on the property are long-term tenants. We're at 96% occupied right now. And we're offering a 206 units, 60% bonus depreciation. We're a 27% IRR. This is a 3-year hold, and it's a 2x multiple. We are offering a 12% preferred return, and it is a 33.2% average annualized return. Distributions we anticipate being the second quarter of ownership. We are a quarterly pay company. We have roughly just under 2,000 assets and assets under management, roughly $240 million currently. We are vertically integrated in construction management. Shane has a very heavy background in construction and development and land entitlement. I have a tremendous background in company management, in solar and construction and general contracting myself. Nick Bouquet is definitely the guru when it comes to spreadsheets. He does all of our underwriting. He is the CFO of the company, does a fantastic job. We have Sean Hinton that also is our construction manager. He is local to Dallas, so he will actually be on property every single week. So that gives your safety and security measures there. And also we have CAF, which is the company management or property management company that manage one of our assets currently that's 419 doors up the road. So it's not a new property management company. We are looking at hiring the in-place staff currently to bring into the team to be able to manage the property continuously. So, we've kind of mitigated our risk by, doing the things we've done. We've done all of our due diligence. We found the skeletons in the closet that we can search for. We got our construction bids in. We've reviewed those. We've got contracts that Shane is currently writing right now, along with Sean on. So let's talk about that real quick. When we take over a property, this is a value add acquisition. A lot of the times you take over this asset and you immediately start construction. Well, everybody's in a hurry. So, I'm not going to say we had to learn from our mistakes, but I will say that when we've taken over properties, we've learned from some things that we could do better. And Shane is writing contracts along with Sean because construction starts, you've done your due diligence, you start on this property, and suddenly, it's time to start construction. Well, scopes of work were not identified properly, and doing the construction properly, all those things. You want to touch on that real quick, Shane?
Absolutely. So we have a very detailed process of contracting, writing our own scope of work, our own contracts. We manage construction management in-house. And so unlike a lot of other firms who just sort of hire it out, we have complete control of the process. We contract everything ourselves, highly detailed scopes of work and pricing matrices. So there's no hidden costs. There's no surprises. If there's additional work, sure, we pay for additional work and we execute change orders for it accordingly. But there's not sort of cost overruns, if you will, on a unit by unit or job basis, because we bid it tightly, we manage it tightly, and we just don't accept anything other than its strict adherence to those policies. So the other thing I wanted to add, Eddie, is we own 3 assets in Texas right now. This will be our 4th. We have dedicated asset management. You and I and Nick all fly to every property at least once a month, sometimes multiple times a month, and we're extremely excited about the opportunity. The most important thing about buying in this market right now is the basis. We got this deal super low, 86 grand a door, which if anybody knows Dallas, that is a crazy low for a 1985 asset. I mean, this is mid-80s at 86 a door. We're just stepping into equity here in value. We're very excited about it. And like you said, it's a 3-year hold. So we're going to get in, we're going to do the work, we're going to raise the rents, and we're going to exit this late 26. And we're going to be excited that we did so. So now's the time to jump in. Join us.
Absolutely. So, like Shane said, spots are running out. I was checking the investor portal right now during the podcast. We're like 50% subscribed. So it's now is the time to get your funds in here. Get this, if you got money sitting around, if you've got some your CPA's telling you, hey, you got some tax liability, let us help you. The last thing we probably want to touch on is, what does our debt look like? I know a lot of people right now, especially investors, that are asking the question, is this a bridge loan? This is not. So go ahead.
Yep, we've got fixed rate agency debt from Freddie Mac. It's at 6.35% interest fixed, which for this environment right now, with the treasuries going up close to 5% and the spread on that, that's actually a pretty good rate. It's fixed for 5 years, and we got 1 year of interest only on it, which is more than enough time for us to drive revenue to where we need to get it. So our DSCR is well conserved on this, and we feel really good about the fact that we have great fixed rate debt with an agency and passed all the agency underwriting tests. We don't need to deal with rate caps or any of that.
Yeah, 100%. So if you'd like to learn more about us, you can go to HampshireCAP.com. That's Hampshire CAP. So it's like New Hampshire. So HampshireCAP.com. You go there and you can see the About section. You can see our philosophy. You can see our properties, our team, and the social media we post. Shane and I do weekly podcasts that go on our YouTube channel. We post on social media. You can schedule a call with me on there. Download our free ebook. We're here to add value. So please, by all means, take this opportunity. Go check out. It's Hampshire Capital, and you can find that at hampshirecap.com. And then look us up on Facebook, Instagram. We're on all of them. And we're happy to have you. And we're happy to have this opportunity closing in 2023.
That's right. Absolutely. So appreciate it, everybody. Look forward to joining with you on this investment. And any questions, just reach out.
Thank you all.